Hi, welcome back to the Dummy Investor channel. As some of you might know, I started this channel just to help myself stay focused on my personal retail investing journey. I've been a do-it-yourself investor both in the public stock markets as well as in the private startup space for more than a decade now. And needless to say, I've made many mistakes over the years. And one of the things that I've started appreciating a lot um, as I grow into becoming a more serious, focused investor is the importance that a sound portfolio investing strategy plays in the kind of wealth that we generate. Now, just before starting out, as a disclaimer, I do want to emphasize that by no means I'm an expert. What I share here is obviously my perspective based on my personal experiences and where I'm in my investing journey. Um, Also, please do use your discretion to take whatever you can take out of this and adopt it in your retail investing process. And let's begin. Now, um, the reason why having a sound portfolio investing strategy obviously is based on my experiences of having made a lot of mistakes when I started out in my investing journey. When I started out more than a decade back, I was a trigger happy person in terms of putting money wherever I thought I could make quick gains. Buying shares of random companies, working on, quick tips or working on news information. And really, the whole approach was very tactical, very narrow-minded, very ad hoc at best. Uh, I would say that I did have something what people say as beginner's luck, wherein I made some initial amount of money, and that sort of reinforced the whole cycle, so to speak. But over a period of time, obviously, because the portfolio was such a mishmash of so many random companies, when difficult business cycles came or difficult market cycles came, I had to lose a lot of money as well in the process. And what that has taught me is obviously to just take a step back and really reflect on how one goes about building a retail investment portfolio, which is durable, sustainable for the long term. Um, it's a work in progress. Portfolio building is always work in progress. That's the first thing to remember. So imagine it's almost like you're building a house and you're always fine tuning something or the other based on new experiences that you have, based on new learnings, based on new things that you want to include as a part of your house building effort. And having said that, the broad direction of the portfolio doesn't or shouldn't change too much. And really, that comes from point one that you see on the image here. And what's the purpose of, uh, you know, your investing philosophy? As retail investors, obviously, each of us wants to invest money and have good appreciated returns in the stock market for different variety of reasons. It could be gaining financial independence. It could be, uh, saving something for your retirement. It could be, growing wealth for a specific goal. Uh, or it could be just, the thrill of investing in the markets more than anything else. But I think it's important, whatever that purpose is, to really keep it, center in uh, our minds while we are building a portfolio from grounds up. And the reason why it's important is it helps us to stay on track in terms of either avoiding pitfalls or getting tempted by short-term tactical, uh, temptations or getting overwhelmed by panic selling. So, uh, you know, first thing that I'm of the opinion we should all do as retail investors is to really define a well-rounded purpose in terms of why we are investing in the equity markets. Now, that purpose, once it is framed, will obviously then shape a lot of things in terms of how we deploy our money, how we deploy our capital, um, depending on how big the ambition is, or how small the ambition is, or how short term the ambition is, or how long term the ambition is. The decisions that we take will obviously vary, and that is of critical importance. Just tying it back to some of the mistakes that I made when I started off. When I started off almost a decade back, or more than a decade back now, obviously I didn't have any specific purpose in terms of investing in the markets, and my decisions were all random. You know, I would pick companies which, on whims, and which I thought would give me 2x, 3x, 4x returns without trying to understand, how the company is operating in the business cycle, and, where it is in the market cycle. Um, and it, you would say that I sort of ended up having some sort of beginner's luck. But as the business cycle went through its ebb and flow, I did end up losing a significant amount of money as well. So please spend some time defining your purpose. I think that's very important. The second thing is also to just better understand yourself in terms of what personality you have and what mindset you have with regards specifically to investing. Are you a risk averse person? Uh, are you more aggressive, or can you withstand losses, short-term losses? Uh, uh, does it worry you to see red on your screen? Do you lose sleep at night? All these are sort of important things to introspect upon, and they also play a role in defining how your portfolio should be constructed. The other thing is, of course, to not let beginner's luck or the mistakes that you've made in the past, and I really call them lessons, to either overexcite you or demoralize you too much. And you know, if I were to sort of describe my investing journey, I started off investing, and I met with a lot, some amount of beginner's luck, and I really got enthused by it. And the first, I think, 1 or 2 years were great, and that sort of made me overconfident in terms of how I was allocating my capital, what kind of returns was I expecting from my portfolio, and that created hubris. And as a subsequent process, the next few years, and of course, coupled with market conditions, I ended up taking a lot of losses. Now, having seen both the phases of the market, I'm at a place right now where I see these as lessons, as important tuition fees one pays in the market just to develop oneself as a good stock investor. And my request would be for all of us to, take it, at least for the serious ones, to take it in that spirit. Now, coming to the portfolio, depending on where we are in our investing journey, all of us are having some existing holdings in our portfolio. Those could be based on some great decisions we made in the past, or some of the duds that we've had in the portfolio, which we've sort of been very reluctant to sell off at a loss. Either of the case, uh, my viewpoint on this is that whatever has happened in the past is something that we can take lessons from, but not necessarily that which is going to help us in the future. What that means is that at any given point of time, we need to really objectively try and look at a portfolio and see whatever holdings we have in our portfolio, do they really make sense for us to keep holding them, irrespective of whether we are sitting on a profit or a loss. And depending on that answer, the next decision point will be to whether continue to hold on to these companies in a portfolio or not. And so it's important not to let the past existing holdings be a legacy baggage. We should always look at a portfolio afresh and see whether anything that we are holding in a portfolio is making sense at the present given point of time or not. Now, there are three broad factors or three broad approaches that play a role in defining a portfolio. One is, of course, the market conditions and the market cycle that we are operating in. As we speak right now, obviously the markets have run up really high, and this seriously some reservations about what you can find of value right now, based on valuations. Um, Now that obviously acts as an input, but more important, when it comes to building a sound portfolio, there are two broad approaches. One is just what we do as bottoms up stock pickers, which is identify companies irrespective of what space they are playing in, what sector they are in, how big or small they are, and so on and so forth. And just based on what we perceive as how the company is going to perform in the next few years, we just end up allotting a random amount to the company just based on purely instinct and gut feel. Now, obviously, that's a superficial way to approach portfolio building. What I would suggest is a coordinated portfolio building approach, which is basically focused on five broad elements. One is it's always future oriented in terms of capital allocation, meaning if you're say having say 20,000 per month that you can spare for investment, what that means is that over a period of time that will come to around 2 to 2.5 lakhs of rupees that you can set aside for your investment journey. And by extrapolation over the 3-year period, you'll probably end up having 7 lakh of invested capital that you can put in the markets. Now, the idea is to keep that number of 7 lakhs in the back of our mind and then work it backwards and see if we were to start constructing a portfolio right now from grounds up, how will we allocate those 7 lakhs? And what will be the distribution of the number of holdings that we have in the portfolio? How will we allocate these amounts? It just makes the whole process more focused when we know that we have a defined set of capital that we can invest over the next few years, and then makes us very conscious of the kind of companies we want to hold in a portfolio. The second thing is, of course, return versus risk and value versus price. There might be many companies in your wish list that you want to add in your portfolio, but does it make sense to add those companies at any given price? Or does one wait patiently for the price to correct at a reasonable value and we can then wait for it and then add it in our portfolio? Now, once we know the kind of portfolio we are building, it makes us easier not to fall for temptations in terms of buying any company that's available. And we become again very conscious of the kind of companies that we are investing in. The other few things to keep in mind is, of course, sector allocation. Not all sectors fire in the same way during a business economy cycle. There are certain sectors which are sort of, I would say, cyclical in nature, like construction or something which requires heavy capital expenditure. There are certain sectors which are sort of which do well irrespective of business cycles, but they are steady performers. They won't give you great returns because they are not cyclical in nature. And I think it makes sense depending on what your purpose is. Coming back to point one, to really understand what kind of sector allocation strategy you want to follow. The other is just in terms of market distribution strategy as well. Obviously, where I am in my portfolio is it consists of a few large cap companies which continue to dominate in the market space, but also, future potential companies which can over a period of time grow bigger, and these will be typically small to medium cap companies. And each one, depending on what our purpose objective is, what our risk profile is, what our return profile, return expectation is, obviously this will have a role to play in deciding how we want to allocate companies. And finally, whether we want to have a very defensive portfolio, like I said, companies which do well traditionally across business cycles but are steady performers, or companies which are highly, cyclical in nature, in the sense when they're beaten down, they get really beaten down, and when they go up, they really go up. And again, it comes back to what your risk appetite is, what's your time horizon, whether one is patient enough to hold on to companies over a long business cycle and reap the returns over a longer period of time. But these are some of the factors that at least I am looking at right now in terms of building my portfolio. Like I said, it's always work in progress. What has worked in the past may not work right now, may not work in the future, and one is always trying to fine tune one's portfolio strategy. But as long as we have a broad portfolio strategy, which is future oriented, purposeful, and not random, I think all of us will stand in good stead. So that is what I had to share in this video. Please do subscribe to the channel and like the video if you think this is of any value. Many thanks. Thank you.